What if you could get a slice of the real estate pie without owning a single property? No down payments, no looking for tenants, no property damages, no repairs, calls for repairs, none of that. Just a portion of the profit. It already sounds like a scammy ad, right? But it isn't. It's called REITs, Real Estate Investment Trust, established by Congress in 1960. So average Joe like you and I can get access to invest in large scale real estate. And by real estate, I'm talking a huge range of real estate: apartment complexes, commercial real estate, shopping malls, hospitals, warehouses, storage units, even infrastructure. We're talking cell towers, fiber cables, pipelines. We're talking a whole range of real estate. So in today's video, we'll discuss what REITs are, how you can make money with them, why they are great, why they are not so great, and the top performing REITs if you're interested. But first, do me a favor, hit the thumbs up because so far you've gotten information. And if you like money, discussing money, how to make money, how to spend money, how to save money, how to invest money, then go ahead and subscribe. All right, let's go. A REIT is a company that owns and operates income producing real estate. This income can come from rental income or from mortgage interest on the property. There are private REITs and public REITs. Private REITs do not have to be registered with SEC. There are requirements for you to be able to invest with private REITs. We are not even going to discuss that. We have no interest for this video, no interest in that. We will focus on public REITs. Public REITs are registered with SEC, which means there are several regulations they have to meet. Not all public REITs are traded in the stock market, but for those that are traded in stock exchange, it means you and I, regular Joes, can have access to buy into them. We can buy shares of these public REITs just like regular stocks, and we can trade those stocks. Whenever demand or the value of our ownership goes up, we can sell it and get our cash. A big way people make money from REITs is through dividends. REITs are required to share 90% of their taxable income via a dividend to their shareholders. So if you buy a portion of these companies, they are required to share 90% of their taxable income with you. So you make money with REITs via dividends and you get to buy and sell your ownership at any point. People love REITs because one, the dividend, you stand to make good, reliable income quarterly, annually. Another reason why people love REITs is liquidity. Unlike physical property, where for you to get your money out, you have to sell the property, with REITs, if you need cash, you can sell your stock, you can sell your ownership, your portion of the pie. A major reason why people love REITs is diversity. It's another way to diversify what you're investing in. In this case, you're investing in real estate. You're not investing in a product or a service, a company offering a service. You're investing in real estate. And we know real estate is a tried and true asset. It's had its ups and downs, but for the most part, it's a tried and true income producing asset. So it's a good way to diversify what you're investing in. When it comes to performance, some REITs have also beat the S&P 500 performance. According to NASDAQ.com, since 1994, three REIT subgroups have beat the S&P 500 performance. While S&P 500 had a 10.1% return, self-storage REITs had 17.3%, industrial REITs had 14.4%, residential REITs had 12.7% return. Let's talk about why REITs are not so great. One, the dividend income. We love them for the dividend income, but it's also an issue because dividend income is taxed at your regular taxable income rate. Even if you reinvest it, it still gets taxed. That's a big negative. But you could offset this, and a lot of people do this, by having REITs in their retirement account. So your IRA accounts will be a great place to put REITs because then you don't get that taxation. Another reason why REITs are not so great is that they have to shell out 90% of their income, which means they only have 10% to reinvest in the business, to put back into the business. So that means this is not going to be your growth stock. This is not the stock where you're expecting the value to skyrocket just like that, like your tech stock. And the final reason why REITs are not so great has to do with this dividend income may not be sustainable. Just because they paid out X amount in dividends last year does not mean this year it would be the same. And I've also heard that there can be some manipulation with that, where the income is absorbed in other expenses. And so there really isn't much to shell out. That 90%, there really isn't much of that to shell out. There are several REITs in the stock exchange. So to invest in the right REITs, you would have to do your homework, do research into each company, make sure they're worth what is. No one has time for that. First of all, we're not even experts. So how do you know what you're reading? So thank God there are ETFs for REITs. And if you don't know what ETFs are, then watch this video after this to better understand what ETFs are. But thank God there are ETFs for REITs. So we get to invest in a whole range of ETFs that are already put together for us at low cost. Bankrate has given us the top performing REITs as of July 2024. I cross checked them with the list from Forbes in Monthly Fool, and three of them are on that list. So I'll give you those three first and then the other two. Vanguard Real Estate ETF is the most popular. It was on every single list. It has a 4.2% dividend yield and a 5-year return of 2%. iShares US Real Estate ETF was also on monthlyfools.com and on Forbes. It's one of the oldest REITs and has a dividend yield of 2.9%. Real Estate Select Sector Fund was also on all three lists: Forbes, Monthly Fool, Bankrate. This is a fund that invests in large cap real estate companies with operations in the US. The dividend yield is 3.6% and a 5-year return of 5.4%. Now, these other two were only on Bankrate, not on the other list. iShares Global REITs ETF, they track global index of real estate companies operating in emerging and developing markets, including the US. They've had dividend yield of 3.1% and a 5-year return of 1.5%. And finally, JP Morgan Better Builders MSCI US REIT ETF, that's a mouthful. They track small, mid, and large cap companies, mostly in commercial and specialized real estate in the US. They have a dividend return of 3.4% and a 5-year return of 4.8%. At this point, you're probably wondering, well, which is better? Should I just wait and buy a physical property, a rental property, or invest in REIT? Now, remember, I'm just a regular person on the internet, so do with this information as you may. In my opinion, physical property will always trump anything in the stock exchange. Well, there are arguments to that in terms of return. But if we're talking about owning real estate, something you own and you can control is always king. But it's going to take a lot to get that, right? You need to have 20% of the property value. And properties are so high right now. The price of properties right now, they're super high. Interest rates are so high. So you may not be in a place to, you may not be in a place where you can absorb any risk with having a rental property, i.e., paying the mortgage because the mortgage is so high, or in case there are no tenants, having to carry that mortgage. You may not be there. When you can, I still think it's worth it. But in the meantime, this is a great alternative, right? You don't need 20% to start making money from real estate. You don't have to deal with the hassle of real estate, having to deal with repairs, having to make sure you have the right tenants. You don't have to do, you put your money in, you get your dividends quarterly, annually, whenever. And whenever you need your cash, you sell it. You sell your stock and get your cash. Hopefully the value is higher. At least you cut even, right? So in this case, is one better than the other? Owning something is always going to be great. And I know it's been argued now, but I think owning something is always going to be king. But why not? You don't even have to choose. If you can do both, great. But if you can't own a physical property because it takes a lot to own one, this is a wonderful way to get real estate income without having to deal with a real estate headache. It's a win-win situation in this case. I hope this has been helpful to you. I hope this has really broken down REITs, or at least demystified REITs, so you know what it's all about. I hope this has been helpful. And if it has, let me know in the comment section. Hit the thumbs up. It's a way of letting me know this or the type of videos you would like to see, and I will keep them coming. All right. Thank you so much for watching. I'll see you in the next video. Bye.